many dozens of times in many cities around Canada. And each time it's always been live, and I guarantee you far more exciting and interesting than tonight's will be. Unfortunately, tonight we're going to do the COVID-19 version of the Condominium Millionaire, which is me sitting in my chair, looking at a screen and trying to keep you all from falling asleep. Unfortunately, there's a lot of material. There's a lot to learn. And please stay with it and stick with it, because I guarantee you at the end of it, you're going to come out smarter and better, more aware of how to become very wealthy in the real estate market, whether it's, it does say Condo Millionaire, but I want to tell you that the principles you'll learn today will allow you to become wealthy in the housing market, in the commercial market, in the retail market, and it'll also allow you to get a start in the development market. So I'm going to go through the information as fast as I can, and then I'm going to open up the floor to a few questions, and then that'll be it. So on to the next screen. No, sorry, I'm doing that. Okay, we're going to talk about some economic factors here that will affect your decision and the general decision of someone to be in the real estate market. And one of the things you should definitely know about are some of the statistics I'm going to give you. And some of the statistics I'm going to give you are also going to allow you to understand why today is a great time to enter the real estate market. And so let's look at the condominium vacancy rate. In any city in the world, if your condominium vacancy rate is below 3%, it's considered a landlord's market. So prior to COVID-19, we were sitting at 0.7%. Post COVID-19, so we're still in COVID-19, I shouldn't say post, but months after the start of COVID-19, the worst case scenario was at the end of 2020, the vacancy rate for condominiums was 0.9%. For all intents and purposes, that's zero. And keep in mind that many people left the city in the first 5 or 6 months of COVID-19. And that drove the vacancy rate higher. And what damage did it do? Well, almost nothing, really, in terms of the vacancy rate. Let's look at the apartment vacancy rate. So the difference between a condo and an apartment is a purpose-built building for rental, and all the units in the building are rental, and it's generally owned by one entity. Could be an individual, could be a corporation, could be a pension fund. In 2019, the vacancy rate of the Toronto stock of housing was 1.5%. In late 2020, the rate went to 5.7. So what happened here? Well, what happened is people realized that they could get a condominium for the same price as a 30 or 40-year-old apartment. And many of those people got wise to this and they moved from an apartment to a condo. So the apartment vacancy rate is actually now a tenant's marketplace. So you can negotiate a decent rental rate in a purpose-built apartment building. That's where all the units are apartments. So that's been a great advantage now given to tenants, but specifically in the purpose-built apartment business. I want to talk about GDP growth. Why is GDP growth important? Well, because in the 32 years I've been involved in real estate, I've never seen the real estate economy shrink in a positive market. So let's look at 2019. The GDP growth for Canada was 1.3%. That's generally considered tepid growth, low growth. Generally after a recession, growth would be peaking at 6%, typically 5%. And I would say medium to moderate growth is in the 2.5% range. So in 2019, we had relatively slow economic growth, yet we had a very strong condominium market in the city of Toronto and elsewhere. Let's look at the fourth quarter of 2020. The fourth quarter of 2020, economic growth was 2.3%. So positive economic growth in the last quarter of 2020 in COVID. But overall for the year in 2020, we had minus 5.4%. Now that's actually a spectacular result, because in the early months of COVID, the negative economic growth was in the 15 to 18% range. So a lot of headway has been made to claw back lost growth, and we're now sitting at a position where perhaps our gross domestic product might be less on a monthly basis than it was last year, but it's increasing now in a positive way, and that's amazing for the real estate economy. The unemployment rate, 2019 was 5.7% across Canada. It's now 11.1%. Interesting. So the unemployment rate's 11.1%, yet the economic rate's positive. And we know that real estate prices are rising by incredible amounts. Imagine when that 11.1% decreases to 5.7% or something of that nature. What does that mean for the real estate market? What does that mean for the sustained growth of the real estate market? Well, I think you'd all agree that if unemployment falls and economic growth continues to rise, then the only thing that can happen with real estate is it's going to rise too. Let's look at interest rates for the last 13 years in Canada. This is very important, because real estate cycles and low interest rates go hand in hand. Positive real estate cycles, real estate's rising, generally happens in areas of low interest rates. So look at the chart at 2007 and 2008. Interest rates were a lot higher then than they are now, and we had a recession in 2008. So as the economy was spiking and growing and overheating, the economy collapsed, and often economies collapse at times of higher interest rates. Higher interest rates often mean high inflation. And so anyways, if you look at our real estate economy here, interest rates dropped from around 4.5% to 3%. And then in 2009, they went down to where they are today, roughly, where the Bank of Canada stimulated the economy for the recession to come back. Now, if you look at interest rates, really for the last 11 years, we've had very low interest rates. And now we're at extremely low interest rates. And this is a good thing for the real estate economy. I want to talk about the benefits. So why is it important for people to accumulate millions of dollars in assets and value over time? Well, the reason for that is that most pension funds today do not deliver a defined amount every month. In other words, you used to be able to get a job and get a company pension, and it would be a defined benefit. So you would know when you retired, you're getting $7,000 a month or $5,000 a month. Today, it's a defined contribution, and that means that you contribute money to your pension, or your company contributes money, but there's no guaranteed end amount that you get. So there's uncertainty in all pensions today. So some of the pensions, these old style pensions, are locked in, but anyone who is a new employee gets these different types of pensions. And the bottom line is, without getting too technical about pensions, is that there's less pension money for you to retire on. You can't rely on your company pension, and you can't rely on the Canadian government for your old age pension, because the amount that they're going to give you will not be enough for a living wage. So it's important for you to know this at a relatively early age in your life and start conscientiously saving money so that in the end you can have a dignified retirement. So let's talk about that. In 30 years, you will need $157,000 a year to live like you are today in 2021 at $75,000. So if you have a job right now that's paying you $75,000 a year, that lifestyle, to have that same lifestyle in 30 years, you're going to need to earn $157,000 a year. And that's because inflation starts to take a bite out of your spending power. So that's a 2.5% inflation rate. And granted, in the last few years, we've been hovering arguably in 2%, but I don't believe those government statistics of 2% are accurate. I think the problem is that some of the core elements of inflation, some of the things like real estate and some food items aren't properly reflected, and perhaps oil too, in inflation to make it look perhaps like inflation is lower than it is. Inflation today is higher than 2.5%. And so if you want to have the kind of spending power you have today, the point is you need to have more money tomorrow. So how much money do you need? So if you want to have for 20 years, from say 65 to 85, enough money to pay yourself $157,000 a year, which is the equivalent of $75,000 a year today, you need a nest egg of $3.146 million. That's a lot of money. How are you going to do that? The average Toronto real estate price has risen 948% over 38 years. So the average price of a property in Toronto in 1982 was less than $100,000. It was about $82,000. And today, the average price is over $1 million. Now look at that graph. Remember, this is the average price. It doesn't reflect the real price. It's just the average price, but it does give you a clear idea, if you follow this curve, that prices are rising. Now, you can see there's a period there in the mid-90s where prices weren't rising. In 1989, 1990, there was a horrendous real estate recession. Interest rates rose to over 12%, if you can imagine. And many people lost their homes, lost their jobs, and real estate prices collapsed in Canada. In Toronto, real estate prices dropped well over 20%. So that was the most I've ever seen in my life in a single time, and certainly nothing like that has happened since the Great Depression. And you'll notice that, you know, we had a recession in 2008. What did real estate prices do? They rose. We had a COVID disaster in 2020, and what do you see? Real estate prices rose. We had high-tech meltdowns in 2000. Real estate prices rose. Bottom line is, over a long period of time, if you hold on to real estate prices rise. Now, what is a compounded rate of return? Well, the compounded rate of return of real estate in Toronto on average price has been 6.6%. Now, again, that's the average price. That doesn't mean that if you bought a condominium in 1982 and you sold it today, the return would only be 948%. It could be 2,000%, and your return could have been 12 or 13%. This is just average price. But it does let you know that at 948% return on property, offering a 6.6% compounded return is an unbelievable stable source of an increase in your asset values. And I'm going to talk about that number later when we talk about something called leverage. Okay, we're going to talk about my power presentation. There's an acronym for this, and I'll tell you what it is. There's 5 secrets to real estate success, which is the secret to power. Positive cash flow, using other people's money, a long-term view, easy with managed investments, and residential urban real estate. So the key, in my opinion, to becoming very wealthy with real estate is to follow these 5 things. And if you do, you will not fail. Let's talk about positive cash flow. Positive cash flow simply is the money left in your pocket after you've paid all your expenses. That's rent minus expenses equals cash flow. With a condominium, your expenses could be your condo fees, your monthly proportion of taxes, and your mortgage, okay? So let's look at an analysis. This is a real-life analysis of a new project we're launching now in Toronto called Bauhaus. I'll talk about it later. It's one of the avenues you can use to become a millionaire over time. It's not an instantaneous thing. So look at a purchase price of $636,000 and a down payment, a 30% down payment of $191,000, and a mortgage of 70%. So you've got a $445,000 mortgage, and it's going to rent for $2,425. Now, some of you are going to say, listen, Brad, that's bullshit. You're not going to get $2,400 today. Correct, you're not. You would have got $2,400 for this apartment if COVID-19 didn't come along, because this apartment is renting in 2019 for $2,300. So you would have easily got $2,425. But COVID-19 came along and real estate prices for rent dropped 20%. They're on the way up again. Rental rates in Toronto have risen about 10% at the bottom in say October. And I believe between now and September they'll rise another 10%. And we'll be back to rental rates similar to what they were prior to COVID. But this building is going to be finished in 3.5 years or 3 years. And I'm absolutely 100% sure that in 3.5 years, the rent will be around $24, $25. So this is buying a new condominium from floor plans, putting a deposit down, and then in 3 years, getting a mortgage, getting a tenant, and so on. So if you look at the numbers here, the total cost of owning this is $2,418. So you're making $7 a month positive cash flow, or $100 a year. Now you're going to say that's kind of shit. And I agree. It's not a great amount of money to make on a monthly basis in a condo, but it is positive cash flow. And I can tell you that in 2021, in any city that you're going to want to live in the world, it's very, very difficult, if not impossible, to buy a condominium, put 30% down, rent it, and make it even cover the costs. I'm going to show you something in the next slide how you're making money, but just on rent and your expenses, you're more or less breaking even. You may do better. It's entirely possible this apartment for $2,500 in 3.5 years. But let's just say this is a fact. You can work in other cities. So for instance, I'll tell you, a city like Calgary and Edmonton, which are crisis cities, where the real estate markets are in a terrible way, better than they were a year ago, but in a terrible way because of oil prices. You can do better in Calgary than you can in Toronto with rent versus the cost. So you can buy a place in Calgary, put 30% down, and the number's more than $7 a month profit. But Calgary's a very unstable marketplace. So is Edmonton. It's oil related. And so for safety of income, I like Toronto. And I'm going to show you something else that you didn't know, I guarantee. Okay. You've bought this property, you've rented it for $24, $25 a month. Every single month, your tenant's paying your mortgage. But guess what else they're doing? They're paying off your principal. They're reducing the amount of money you owe the bank. That, in effect, is money in your jeans. So in 1 year, you've paid off $10,129, plus you made a rip-roaring $84.30 from the tenant on the money over and above the cost of owning it. So you actually have increased your net worth by $10,213 in the first year. This is the first year. It's never going to get worse than the first year. That's a 5.4% return on your money. Now, your bank's not paying you 5.4%. So you get 5.4% return on your money in year one in a condo. It gets better year after year after year. But additionally, you've seen properties rise by 6.6% on average. So in addition, on average, this property that was $640,000 has gone up $40,000. So $40,000 plus $10,000 is $50,000 profit in year one. So you got to keep in mind that if you can buy a property, rent it, and cover your costs and make a positive return like you have here, it's a holy grail. It's hard to do in any city, and you can do it in Toronto. Okay, other people's money. This is very important. Other people's money is known as leverage. And anyone, you look at anyone who's made millions or billions or hundreds of billions of dollars, they use other people's money. They don't use their money. They borrow money. They raise equity. People that own hedge funds, they get other people's money into their hedge fund. They have a small amount of money, and they expand that hedge fund, and when the hedge fund gets bigger, they benefit from it, other people's money. It's the most important thing you need to know about getting rich in real estate or in anything. Okay, so why is this lucrative? Well, I call it the equity multiplier, and here's why. I'll give you an example. If you buy a condominium for $500,000 and you put $500,000 down, so in other words, you have no mortgage, and you're going to say to yourself, that's crazy. Who does that? You know what? Tons of people do that. Many, many people now buy real estate for cash. So I don't think it's a wise idea, but lots of people do it. Let's look at the alternative. Let's say you buy it with $100,000 down, you have a 20% deposit. Now, that's called leverage of 5. So how you calculate that is you take the purchase price and you divide by the down payment, and that's your leverage, 5, okay? Why is that important? Here's why. If the condo goes up by $25,000 over 10 years, or sorry, 25% over 10 years, that's a $125,000 increase in the property over 10 years. Okay, guy number one, lady number one, that bought the condo with $500,000 cash, what did they make? They made $125,000 over 10 years divided by 500,000. They made 25% on their money, 25% return. However, the person that used leverage and bought the property with $100,000 down, well, they made $125,000 divided by their investment of $100,000, which is 125% return. You see? That's leverage. That's how you get rich. Leverage increases your return on invested capital. So for instance, instead of buying one condo with $500,000 down, you buy 5 condos with 20% down or $100,000 down. And instead of making $125,000, you make $725,000. $750,000, sorry. That is the secret of leverage. It's the most important thing about real estate. And you can't do it with stocks, you can't do it with your company, you can't do it with anything. You can only do it with real estate, because real estate can be rented and the rent covers your costs, and lenders understand that. So they'll let you borrow money and the tenant pays off your debt. It's beautiful. Okay, a long-term view. Nobody gets rich quick. It's a fallacy. Even people like Elon Musk that started a company before Tesla, it didn't happen overnight. And people who invent something, create a patent, go public, it looks like it's so easy and they make all this money quickly. It's extraordinarily difficult. There is no way to get rich quick unless you go to a casino and make a bet and you get lucky, or your dad dies and he's rich and you now inherited money. Okay, that's a way. But for average people, you get rich over the long term. Long-term investing minimizes the need to worry about market cycles. We looked at the long-term valuation of real estate in Toronto, that 42-year or 52-year, 58-year duration of a 948% return. If you had bought at the start of that cycle in 1982 and sold now, it's 950% increase, 9.5 times your money. Think about this. What if you bought with 20% down? If you bought with 20% down, that's 5 times, 9.5 times your money. That's 47.5 times your money. 47.5 times your money. If you buy a stock for $1, it goes up 47.5 times. That's $47.5 a share. That's what happened in real estate in Toronto if you use leverage of 5 or 20% down. It's unbelievable. So the point of this is that if you buy year to year, you might buy in a year like COVID. Maybe you bought in January 2020 and COVID comes along and knocks the world on its ass, and we have this horrible pandemic and real estate prices might fall. Well, you don't want to sell. You want to hang on. Bubbles don't matter. Real estate corrections don't matter if you buy for the long term. Continue ownership through all cycles, up or down. Just keep the property rented. I want to show you a couple of things. So the top graph is the annual growth rate in Canada from 1981 to 2020. Those 4 bars that are pointing down are recessions. You get a recession in Canada or generally in the world about every 10 years, 7 years, 8 years, 10 years. They're almost always manufactured by the government by increasing interest rates to slow down an overheated economy. But look at this, 4 recessions. We had what's called the Great Recession of 2008. I would say the recession of 1991 was far worse for real estate. And you can see that reflected in the graph because real estate prices actually fell for several years and then started to rise again. But nonetheless, it doesn't matter where you bought on this curve. If you bought somewhere on this curve and you still own your real estate, you've made out like a bandit. Long-term ownership. That's the secret to success in real estate, or one of the 5 things. People that want to buy a condo and flip it, they're idiots. There's no money in that. There's only money in long-term ownership. You buy the property, you rent it, and you put it away and you forget about it. And you wake up 25 years later, and guess what happens? You have no mortgage. 25 years of ownership or longer, and you've paid off your mortgage. So you own the property outright. Take advantage of inflation. This is another reason why you want to hold on to real estate. There's inflation in the marketplace. So think about this. Let's say real estate rises 2% in value. If you've put 20% down on the property, then your investment of 20% rises by 10%, not 2%, because you have leverage of 5. So look at this. You got $5. Let's say you got $50, and inflation is 2%. So there's a rise in real estate of $1, right? $1. That's a 2% increase. Now let's say instead of investing $50, you invest $10, and it goes up $1. You made 10%. That's how inflation benefits investors. Leverage, time. This is how investors beat inflation. Inflation, listen, if you own hard assets like real estate, inflation is your friend. Number 5, you enjoy an increase in cash flow year to year. So here's what happens. The longer you own real estate, so mortgages, the principle of a mortgage is set up so that you pay the least amount in your first payment and the most amount in your last payment. It's called front loading. That's how mortgages are calculated. So, I said that in that example, $10,000 is paid off in year 1. In year 2, you pay off $12,500. In year 3, you pay off $15,000. Every year, you pay off more. Your tenant's paying off your rent, or paying you rent, and they're paying off your mortgage in larger and larger amounts as you get deeper and deeper into the mortgage. And guess what else happens? You raise the rent. There's no rent controls on properties built after 2018. November 2018, no rent control. If you have a tenant in a property and they're paying $2,000 a month and you think it's worth $3,000 a year later, you can ask $3,000. It might not be a nice thing to do, but you could do it. And the tenant would either have to pay or leave. So no rent controls means that you can raise the rent, and that means you can make more money. You pay off your mortgage in 20 to 25 years with the tenant's money. Now, here's the secret to real wealth building, okay? You have a condo, you bought it for a certain price. Rather than sell it, refinance it. Why? Well, you refinance that property, you pull out the money, you buy another property. When you refinance a property, the money you pull out is tax-free. You haven't sold it, you've just refinanced it. So I'll give you a quick example. Let's say you buy an apartment for $500,000 today, and it goes up in 10 years to $800,000. You go to the bank and you say, okay, listen, I had a $500,000 mortgage. I now owe $400,000. I paid off $100,000. So I had $400,000 in equity. I want to take $200,000 out and buy another property. The bank lends you, they take your mortgage from $400,000 to $600,000. You got $200,000 in equity. You got $200,000 in cash. You buy property number 2. Now you own 2 properties. and you own two properties with just the money you bought the first property with. And the money you pulled out is tax-free. So the government doesn't get a penny from you. It's all still in your pocket. And now you can build wealth with two properties. Easy. Everyone likes easy. No one likes difficult. No one wants to work too hard. So condos are great because they're managed. Why are they managed? Because each building has a condo management company managing them. So if you buy in a condo building, the building is being entirely managed by a professional company. So it means you have no maintenance. So if the windows are dirty or they need fixing, or some dog did a little poo-poo on the carpet in the lobby, is that your problem? You pay your condo fees, your tenant's paying you rent, and you're paying your condo fees for the rent. So who cares? The condo board, condo corp takes care of it. You don't have to do it. You have to worry about it. It's already taken care of. If the building is 10 years old and people in the building feel that the building is long in the tooth, it needs a renovation. Well, part of condo management is creating a reserve fund for that exact purpose, so the building can stay current and attractive. You don't have to worry about that. If you buy a 10-unit apartment building, you got to worry about that. So no maintenance means no foundation issues, roof issues, window issues, heating issues, ventilation issues, plumbing issues, parking issues. All of that stuff is taken care of by a professional. That is a low maintenance investment. And that's why condos are amazing. Insurance is minimalized. You just have to get a contents package. It's like $35 a month. Buy only new condos. Why buy only new condos? We'll tell you why. You know, people say, oh, you know, they don't build buildings like they used to. Bullshit. Old buildings are shitty. Old buildings were never built with the same level of engineering and technology and standard. Think about it. Think about how people built buildings 150 years ago. My God, what a toiling, terrible task. But, you know, there was no drywall. There was the roofing systems were terrible. You know, there was no factories making perfectly measured 2x4s or 2x6s. Nothing is plumb. Let me tell you, buildings built in 2021 are infinitely better to live in than old buildings. Old buildings are a pain in the neck. They're always breaking down, falling apart, need money. So you buy a new condo, you're not getting someone else's garbage, you get your own new condo. You pick it from floor plans. So you buy it from a developer or a broker. You pick the floor plan you want, you pick the floor you want, and then you get to decorate it the way you want it. So it's your condo. And so, you know, going forward, it's your problem. If there's you know, you're not buying someone else's problem or someone else's history or someone else's junk. Technology has improved night and day. Systems are more green now than ever before, and the windows are better. The insulation is better. Everything is better. And you know, if you care about carbon emissions, new buildings are infinitely better for carbon emissions than old buildings. Old 100-year-old buildings are terrible as a carbon pollutant. Always ensure that a tenant makes your full application to lease. You know, a lot of people, when they're landlords, they put on their nice guy hat, and that's fine. If you want to be a nice guy landlord or a nice woman landlord, be my guest. But you will make less money. And if you're in this as a business to make money, then you need to think like a businessman or businesswoman. So, number one, credit report. You have to have a credit report. And if the credit report isn't strong, you can't take the tenant. You need work references. People make up work references all the time. They get phony letters. You need to call the work references. You need to make sure that the person you're talking to actually works at the company on the top of the letterhead. You need proof of annual income. I've had tenants forge their tax returns, phony tax returns. And when you analyze them, you look at them, you can see there's mistakes in the calculations. That's how we've caught people lying about that stuff. So you need proof. That's like a stub from a company or a letter from the boss to show that it's signed by the person that employs them. that they're actually making that money. You'd be amazed what people come up with. Past landlord references. Don't ask for past landlord references and then not call them. You know, a past landlord reference that's their mother or father or their uncle is no good. Because what are they going to say? They're going to say, great people, fantastic tenant. You need to get a third-party landlord reference and personal references too. And why is this important? This is why it's important. Once a tenant's in your property, it's hard to get them out. So make sure if you put a tenant in your property, you've done the research that you want that tenant in the property, okay? Now, I always suggest you get first and last month's deposit, put it in your agreement to rent, and insist on getting it. We always get it, and I highly suggest you do. Because if you don't get first and last month's rent deposit, you know, and the tenant doesn't pay their rent for 1 month, you have no ammo in the, you know, you have nothing kind of in the kitty to protect yourself from a vacancy. And the whole thing here is, you know, when you're buying real estate, you want to feel safe, you want to feel protected, you want to feel comfortable. And the wild card for you, you buy a piece of real estate, the wild card is the tenant, the rent. So you want to make sure that your rent is stable and secure. So be careful and smart. By the way, I would not recommend giving someone an apartment with a credit score less than 700. Okay? Insist on 10 post-dated checks. Put it in your lease. What we typically do is we don't advance someone the keys until we get the post-dated checks. This is something that is, so you cannot force someone to give you post-dated checks, but it's a convenience to everybody, and you should work very hard to convince your tenant prior to them getting into the apartment that post-dated checks are the way to go. You can also, you know, you can also have automatic debits and things like this, but I like post-dated checks. Now, I told you there's no rent controls. That's a good thing for landlords. And if you're going to adhere to this and actually do what I say, you're going to become a landlord. So listen, you raise the rent when you can raise the rent. There's going to be times when rents fall, like in periods like COVID-19 or recessions. Raise the rents for the good times. When rents fall in the bad times, you'll have some protection. Quality tenants in Toronto are easy to find. And go to the bank once per month and you forget about it. Okay, residential urban real estate. Only buy condominiums in big cities. Now, what's a big city? Hamilton's a big city. Ottawa's a big city. Montreal's a big city. Calgary's a big city. Outskirts of Toronto, like Mimico and Queensway and Scarborough, and they're part of the big city, okay? You want to buy in urban density. Why? You want to buy where there's lots of people to rent. Big cities don't collapse when one large employer leaves. That's why I don't like Ottawa, and I don't like Calgary, and I don't like Edmonton, because they're not rounded cities. They're becoming more rounded, but government towns benefit at times when there's liberal governments, and they do bad in times of conservative governments. There's less jobs, less money. And oil towns and boom towns, they boom and they bust, they boom and they bust, and the timing of that's difficult. So I like stable cities like Montreal, Hamilton, Toronto, London, Ontario is pretty stable. Cambridge, Waterloo is pretty stable. Toronto's my favorite. That's where I think you should focus. Big cities offer higher paying jobs. Population growth benefit big cities. Toronto grew in 2019 by 128,000 people. It was the fastest growing city in North America. It beat Dallas-Fort Worth by 12,000 people, which is the second fastest growing city. And it's the fastest growing city in the free world. Living in the suburbs means driving your car everywhere. It means having a larger imprint of land. It's wasteful. It's not carbon efficient. And going forward, society is going to demand more of people that make that lifestyle choice. There'll be more taxes, more costs associated with living a more carbon. If you use more carbon, you're going to pay for carbon. So what is the most efficient way to live in the city and in buildings amongst clusters of human beings It's also a great lifestyle because you walk outside your front door and there's many people and many things to do. And humans like humans. Easily managed property, as discussed. You're in a condominium. Large pool of wealthy young talents. People get paid more in Toronto than they do in Guelph. Higher city rents, wealthier tenants mean less defaults. People that make more money tend to default less in the rent. Bigger jobs, more to lose. A corporate lawyer making $150,000 a year is not going to not pay rent, because if they don't pay rent, they're going to be on the street, and they can't be a lawyer living on the street. Let's talk about Toronto new home sales. There's a trend going forward here. In the year 2000 and the years after that, for about 5 years after that, around 20 to 25% of new housing was high-rise or condo. And it's slowly being increasing. It was a max of 85% in 2018, 83% in 2017. It's been rising. Will continue to rise. There was a setback in COVID-19 because people went running for the country. It's not a long-term trend. It can't possibly be a long-term trend. With the issues with greening society and carbon emissions, we can't all run out to the country and live on 1 acre lots of land. It won't work. So, of course, sanity will prevail and people move back to the cities in the coming months and years. Cities are the future for rental property. No one's building any meaningful quantities of apartment buildings in Toronto. And the reason why is because apartment rents don't justify building large-scale apartment buildings. It's difficult to build a large apartment building and earn a return on your capital. A small investor can get a return on capital, but a large-term investor, it's difficult to do that. So this is the vacancy rates of apartments versus condos. You can see that always, except for 2016 and 2014 and 2011, that the condominium vacancy rates were lower than apartment vacancy rates. And there's specific reasons for those. There was periods of overbuilding of condominiums, little bursts of overbuilding of condominiums. And those eras where you see condos vacancies a bit higher than apartments were those eras. But you'll still notice that in the past 13 years, we've never seen a vacancy rate higher than 2% in the rental condominium market. That's a long period of time for a very low vacancy rate. Let's talk about immigration. Immigration is what fuels this growth of the city. It's what fuels the demand for real estate. This year, we're going to let in allow a record of 400,000 new immigrants into Canada, and roughly a third of those find their way into Toronto. And the plan is to increase it by 15,000 people per year. Huge pressure. You know what's going on in the United States? Huge pressure on the southern border for immigration. People want to live in Canada, the United States. There's way more people that want to live here than we can let live here. And these numbers are only going to increase. And if they increase, and they will, it's going to put pressure on rental rates and prices of real estate in Toronto. So it's a good thing for real estate owners. You're more likely to find tenants in densely urban populated centers. We talked about this, but just look at the growth of Toronto as a city. In 1986, there were just over 3 million, just under 3.5 million people, and today we have over 6.5 million people. 3 million people in 32 years. An astounding rate of growth, one of the highest in the Western world. Only by junior one bedroom and dense, small 2 bedrooms. So the point here is you want to buy smaller apartments because properties rent for more when they're smaller per square foot. So, for example, today a 500 square foot apartment rent for about $2,000. That's $4 a square foot. A 1,000 square foot 2-bedroom would rent for maybe $3,000. That's $3 a square foot. Condo fees are the same and taxes are the same on a per square foot basis, basically. So it's a diminishing return the larger you get. So don't buy penthouses or large apartments as investment properties if you plan on renting them. Buy the smaller ones, okay? So that would mean 300 square feet to maybe 700 square feet. Those are the ideal properties. So 300 would be a studio, and 700 square foot would be a small 2-bedroom. Okay. Now, also the kind of tenants you want, they're typically younger professional people, and these are people that can't yet buy. So they're the ones that can afford cheaper and smaller apartments. People who want to spend $4,000 or $5,000 a month in an apartment are few or far between. They typically want to buy an apartment. Okay. So you're looking for rents in between, this says $2,200 to $3,600. I would say more like right now, $2,000 to $3,000 is kind of the place you want to be. The beauty of rental properties is that your tenants pay off your mortgage, and you get, and to add to your cash flow, helps you get wealthier. Okay, we're going to go through a land development corp project gallery. Most of you probably know I'm a real estate developer, as well as a real estate investor and a real estate broker. So we also sell real estate. These are some of the buildings we've done in the last few years. I won't belabor, just show you the buildings we do are typically quite nice in architectural style. They sell very well. People do very well buying in them, and I'll go through that in a minute. These are some more of the buildings we've built in Toronto and the area. Sorry, this last one, it's not yet built. This one on the right is Bauhaus. We are going to start selling that. We are selling it now. So all of you can have an opportunity to buy there if you contact my office. We'll talk about that in a minute. The buildings to the left are two we're going to do in Hamilton called Television City. We're getting ready to launch those this fall. Okay, I want to talk about opportunities that people have had and taken advantage of, and how much money they've made in real life. Because, you know, people often say, well, you talk about this, but does it actually happen in real life? Absolutely. Here's some examples. Theater Park, 450 square foot apartment was purchased in 2009 from floor plans for $241,000. In 2019, the unit sold for $590,000. Sold for much more today. That's a 10-year period of holding that. 20% down, that's $48,380. And the return on invested capital was, yeah, there's a mistake here. The return on invested capital was actually 1,100%. It's I stand corrected. The return on capital is about $350,000 divided by $48,000, which is a 720% return. In other words, you made 7.2 times your money. You put $48,000 down to buy this thing. You rented it 10 years later. Forget about the rent. Forget how much money you paid off on your mortgage. You made 7.2 times your money. Think of that. And by the way, Theater Park didn't sell overnight. People had a good opportunity to kick the tires in that project. Harlow is another project we recently completed. 492 square feet, $261,000 in 2013. So you see that between 2009 and 2013, you know, certainly people, oh, 2009, I got priced to the market by 2013. No, $261,000. That property sold in 2019 for $565,000 over 6 years. Okay, a $52,000 investment in 6 years paid 578% return. That's 5.78 times your money. Now, look at this as an annual return on your money. It's about 80%. So, Warren Buffett is the most successful investor, they say. And his company has returned about 16 to 18% per year on a compounded basis. Harlow, if you bought it in 2013, paid you 80% a year on capital gain alone. 80%. King Charlotte's another one. 516 square feet, bought for $278 in 2010, sold in 2019, $565. 5.13 times your money. In 9 years, that's about a 38% return on your money compounded. Insane. The Brant Park, another one. 6.23 times your money. The King East, another one. 710%, 7.1 times your money. Flatiron, 8.1% times your money. We didn't do this once. This is over and over and over. Here's another one, Work Lofts, 800% return on your money. Glass, 1,209% return on your money. That's 12 times the money you invested, 12 times. Over a period of 14 years, that's about a 65% return on your money over 12 years. That's not an accident. Okay, we're going to talk about how all of you could do that again, if you want. Bauhaus, this is our next project. I'll take you through it very quickly. I don't want to bore you about it. These are some images of Bauhaus. It's on King Street East. It's a beautiful building. Peter Clues of Architects Alliance designed it. It's a piece of architectural splendor. There it is. Lovely. Modern architecture. This is the party room. It's got the themes of the Bauhaus movement, the 1920s German movement of modern architecture and styling. There's the gym. You can all get fit, your tenant can. There's the lobby, a beautiful, very clean, modern concrete and wood lobby, just like the Bauhaus movement. There's the lobbies, beautiful, or there's the hallways, beautiful hallways. Okay, we're going to take you through a few examples of today, how you can get in the marketplace and earn some incredible returns over the long term. Now remember, all of those things I took you through, those 10 or 12 examples of all of our projects and how everyone who bought them made a fortune, you could do it again, but it's the long term I'm talking about. I'm not talking about buying and then 8 years later you sell. If you keep holding on to the property and you refinance, you can end up with 20 properties by the time you retire. 20 properties, 30 properties, 40 properties. I have many clients that we started with 20 or 25 years ago that are worth 20 or 30 or 40 million dollars, and they have dozens of condominiums. Okay, so you can do this. You just got to start. Now here's an example. This is a building in Bauhaus, unit in Bauhaus, $625,000 to buy. Okay, we're projecting rent to $2,300, which I think it's lower than we'll get in 3 years, but let's just say that's what it is. At the end of this, you know, there's the $618 a year rental profit, so it's about, I don't know, $60 or $55 a month, but it's still positive return. So your tenant gives you the rent, you pay all your expenses, you got 50 bucks. So you're not feeding the property, there's a positive return. And every year after that gets better. I want to show you how. So after 1 year, with just the money the tenant's given you, you got a 6% return on your money. That's $11,400 divided by $187,000. Okay? Now, let's look at your accumulated return. This includes the money you make from capital gains. Now, if you read the small print here, we've got rent increases of 3% annually, mortgage rates at 3.5% for the first 10 years, then 4.5% for the next 30 years. So those are higher than we have today. And the other assumption is that there's a 2% condo fee increase and a price increase, a property value increase of 2% and a condo fee increase of 3%. Sorry, I had to squint. So very, very conservative property price increases. And after year one, you make 22.7% compounded on your $187,000 invested. So what is that? That's about $40,000 you make year one. You invest $187,000, you make $40,000 year one. Now think of this. After 25 years, your mortgage is paid off. So you own this property, the $625,000 own right, outright, no mortgage. What is that worth in 25 years? $1 million, $2 million, probably $2 million. So you have $2 million investment without a mortgage. So if you have 5 of these, you got $10 million. So that whole math I told you about retiring with $3 million to have $157,000 a year. If you have $10 million, you got $450,000 to spend a year in your retirement for 20 years. That's how you can retire in style. Let's look at number 2. This is another property. It's a one and den, and it returns a bit higher, 6.32% return. And year one, it's a 22.9% return. Now I don't go to the next one, and this is a one and den, a bit bigger, very similar, 6% return and a 22.6% compounded return with capital gain. I don't want to bore you all about, I don't know how much any of you know about rates of return. It's just this simple. A rate of return is trying to bring a property or investment down to the same thing as bank interest, right? So this is the equivalent of getting a 22% return on your investment. So if you put a GIC into with the bank and they give you 22% a year, that's the same thing as you'd get on this. Now, there's some risk, there's some work, but I guarantee you, if you go and you buy a GIC at the bank today, you're getting 1%, maybe 0.5%, versus 22.6 for making some effort. Now, the beauty of this is that, look at after 30 years, you've got a 1,600% return on your money. That's a 16 times your money. That's how you get rich in real estate. Everyone says to me, for the last 32 years of me selling real estate or developing real estate, I've heard this story. It's bullshit. I've missed out. It's too late for me. It's never too late for you. It's never too late to get started. I promise you, today is as good a time as it was 5 years ago and as good a time as 5 years before that. Get into the real estate market. If you want to become a real estate millionaire, it's not going to happen by sitting on the sidelines. That's the end of my presentation. So if there's any questions and you've sent them to our, our staff here, I'll answer some of those questions. Okay, question number 1. Would you advise purchasing a condo that is cash flow negative in the short term? Yes, I would. I think that in Montreal, in Toronto, certainly in New York City, in Miami, in LA, in London, I could name 100, Copenhagen, Stockholm, 100 amazing cities that people live in or would like to live in. Often in the purchase of a condo year 1 to year 5 could be negative cash flow. That's okay. What will happen is every year the negative cash flow will shrink by more and more and more. So it becomes positive cash flow. Now, I'm not suggesting thousands of dollars a month. If your negative cash flow is a few $100s a month and it doesn't affect your lifestyle, it doesn't affect your ability to pay your bills, I'm saying do it. And have the property appreciate in value, then you can refinance that in 5 or 7 or 10 or 12 years and get property number 2. Next question. What happens if interest rates triple and I have all this debt? Get a shotgun, put it between your legs and pull the trigger. It's not going to happen. It's nonsense. Unfortunately, listen, if you live your life believing that kind of stuff, you'll never get out of your chair and take a step. That's never going to happen. That's nonsense. So, and if it does happen, let's say it did happen. Okay. You know, when I say it's nonsense, real estate, people have gotten mortgages for 1% or 1.5%. So to go to 4.5%, that's not nonsense. That wouldn't change anything. That would not change your payments materially. But you know, if interest rates were at 4%, went to 12%, it would, first of all, it wouldn't happen overnight. Like if the central bank took interest rates from 4% to 12% overnight, the entire world would fall apart. There'd be murder on the streets. It's not possible. However, it is possible for interest rates to rise, and that's why you hold property for the long term. So, okay, if you buy a property year 1 and you get unlucky and interest rates rise and it hurts a bit for a year, I showed you the inflation. I showed you the recession chart, right? 4 recessions in 40 years, 4. And each recession averaged about 9 months. So you get 9 months of pain and interest rates fall very quickly after recessions. So the key is don't get a property that's too cash flow negative. Raise the rents, as I tell you. Get good tenants, stable tenants, do the work, raise the rent every year. It doesn't matter if the tenant says, oh, I'm sorry, it's uncomfortable. It doesn't matter, it's your property. You are allowed to raise the rents by law, and you should, okay? To protect yourself when things do turn sideways, because believe me, things will turn sideways. Life is not always up, 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 up. Sometimes it goes down. And when it goes down, you need to be prepared for it. But over the long term, real estate prices always rise. And if you're a believer that the population of Canada is going to increase, which it absolutely is going to, real estate has to increase too. Next question. I'm reaching my max capacity of lending. I make a good salary. My properties are 60% loan to value. How can I increase my lending power? Well, you may have overextended your lending power and you maybe need to take a break. But, so one thing I didn't talk about is banks don't want to give you more than 6 or 8 mortgages. You can have a cottage mortgage, a house mortgage, and maybe 5 or 6 others before their brains explode and they can't comprehend why anyone would want to do that. That's just our Canadian banking industry. It's very small-minded. You're going to have to get creative. What I did many, many years ago, the first thing I did when I started my real estate company in 1984, I was 20 years old or 21 years old. I incorporated a company and I bought all my real estate except where I lived in companies. Now, you're going to pay more money for the loans, but there's advantages to buying in the name of a company. And I'm not the one to give you that information today. That's another conversation. But what I would suggest is this person asked this question, going forward, incorporate, form a company. You're gonna have to get commercial mortgages. They're more expensive, but believe me, paying 3 or 4% interest is nothing when your returns are 22% a year. Nothing. Okay, next question. Can you refinance in multiple properties, like on your second or third property investment? What would you advise that? Absolutely. Do not sell ever. Don't. Refinance your properties. You can refinance your second, third, fourth, fifth, 10th. I have a client that bought about 15 properties from me in the late 80s, and he's been living off that by refinancing, buying more. That guy has 45 properties now. It's worth $25 million. And he did it by buying 15 properties back in the days when they were like $120,000, $140,000 for a condo. But we're talking, 1988. So 32 years ago, right? And he still owns those properties. So yes, that's a good idea. Higher construction costs affect construction costs in the future. Absolutely. Our biggest 2 problems in our industry right now are construction prices getting totally out of control. There's lots of reasons why. I'm not going to blame anyone, but there's lots of reasons for that happening, and it is happening. And also the city's getting greedy and increasing development fees and taxes. But 25% of the cost of a new property in Toronto is taxes, city and province. It's terrible and it's greedy and it's hurting people. Developers make a margin. It never changes, but they just take the cost, they add the margin, and that's the price. So prices are going up. They're absolutely going up. There's no question. So if you have a condo you bought years ago for $1,000 a foot or $800 a foot, you can clap your hands together because those will be $1,500 a foot in 5 years. Why do developers build bachelors around 500 with no bedroom? Do they sell as quickly as 1 or 2 bedrooms? Are you finding the rent for these? Okay, so listen. If you're an investor, think about this. You want to rent property that people can afford. What can people afford? The cheapest rentals. What's the cheapest rental? The smallest apartment. The first apartments, if I develop a building, 250 units, and I have 100 studios, we're doing studios now 320 square feet. Those 320 square foot units sell instantly. They're the best investments, and it's what everybody wants. And they rent just like that too. So that's why developers build them. If I could only build studios, I would, but the city makes us build 25 to 40% 2-bedroom, 3-bedroom. I don't want to build a single one. If it wasn't for the city, we wouldn't. People are renting and buying the small units. That's where the demand is. What's the most desirable location for within a condo building in regards to rental resale? Yeah, listen, I wouldn't buy above the garage. Where the garage goes up and down, you can hear the noise. There's no. I've made a living as a developer and as an investor buying lower floors. If I build a 40-story building, I usually buy the 3rd to the 10th floor, because at the end of the day, it's the building's the building, and there's so many buildings around. It's unlikely you're going to have a guaranteed view forever. So don't worry about that. Worry what you can afford and what makes sense. All condos in all buildings sell. This is the last question. Do you have any recommendations for suburban areas in the GTA that you think would be great investments long-term? Burlington versus Milton versus Oakville. Okay, Burlington and Milton and Oakville are not cities, they're suburbs. And you got to get in your car and drive to, you know, Mickey Finn's or the local theater. It's not a city. Now, are people living there? Yes, people are living there, and those condos do fairly well. As I said in my presentation, I believe in cities. So I would prefer buying in Hamilton or urban Scarborough or, you know, Mimico or Queensway, those kind of areas that are very either in a city, and Hamilton's a city, and Hamilton's booming. Hamilton's price have gone up more than Toronto's prices in the last 2 years. But I would look at cities if I could. But listen, if you live in Burlington or you live in Milton and you want to have an investment property close by, it's fine. You're going to find tenants for it. And prices in Milton, Burlington, and Oakville are going up just as fast as many parts of the downtown core. So I would recommend that. But primarily what I like, and for the reasons I told you in my presentation, I like urban, dense areas. So I would first pick away at the cities around that. That's it. I want to thank you all for attending. Oh, not too bad. I did about an hour. If you have any other questions, feel free to send them to my team. And I want to tell you about the way that you can register for Bauhaus Condominium. So what is the website? Huh? BauhausToronto.com. That's BAUHAUS Toronto.com. Now, if you attended this seminar, you'll be considered a VIP and an insider, and you get the VIP insider incentives. If you register from this seminar, just make sure in your registration you say you attended this, and one of my representatives will call you. If they call you, call them back, okay? But anyway, yeah, listen, it's been an honor to speak to you all tonight, and I hope you have a good night. Thanks very much.